Because what's happening right now is the reason that Bitcoin hasn't reacted the way people thought post-halving is you have massive arbitrage going on between the big dogs who are shorting the futures and buying the underlying ETF. So most of the inflows to those ETFs are not really retail flows and actual purchases. They're just arbitrage to capture the spread between the future and the spot. The market can be irrational longer than the rational investor can remain solvent. And it's worse now because back then in 2000, most of the money was actively managed. It wasn't dumb. And I don't mean dumb unintelligent, I mean dumb meaning rule-based. Now more than 50% of assets are rule-based. They're indexed, capitalization-weighted. And a capitalization-weighted index has no choice but to buy more NVIDIA as it goes up. It doesn't get to say, this is stupid. Oh, look how strong the dollar is. No, it's not. It's just less weak than the yen or the euro. If you look at it relative to renminbi, it's actually not strong.
Yusko begins the current lackluster performance of Bitcoin, despite expectations following its halving event, can be attributed to this arbitrage. The inflows into Bitcoin ETF, Yusko explains, are not from retail investors, but from institutions engaging in these arbitrage strategies. This dynamic, coupled with the increasing dominance of passive, rule-based investing, has created a market environment where momentum can drive prices to irrational levels. He warns that this self-perpetuating cycle will eventually break, leading to significant corrections. Yusko draws parallels to the early 2000s, where active management was more prevalent and markets were less influenced by passive flows. He argues that today's markets, driven largely by index funds, are prone to excessive volatility. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
My view on that is there was a logic to why Bitcoin and Ethereum were ruled commodities as opposed to securities. And that's because when you deem something a commodity, you can then have futures contracts against it, which then allow you, as Leo Melamed from the CME said, to tame the price. Because what's happening right now is the reason that Bitcoin hasn't reacted the way people thought post-halving is you have massive arbitrage going on between the big dogs who are shorting the futures and buying the underlying ETF. So most of the inflows to those ETFs are not really retail flows and actual purchases. They're just arbitrage to capture the spread between the future and the spot. The market can be irrational longer than the rational investor can remain solvent. And it's worse now because back then in 2000, most of the money was actively managed. It wasn't dumb. And I don't mean dumb unintelligent, I mean dumb meaning rule-based. Now more than 50% of assets are rule-based. They're indexed, capitalization-weighted. And a capitalization-weighted index has no choice but to buy more NVIDIA as it goes up. It doesn't get to say, this is stupid. I won't pay 36 times sales. It has to do it. And because people never change their 401k, they put the money in the 401k every 2 weeks and it goes into the index, and it's a self-perpetuating momentum strategy until it breaks. Now, when it breaks and goes the other way, glory, hallelujah, we will go down 70, 80, 90, I don't know what the number is, but there is no number. There's no math. There's nothing on the planet that can rationalize any multiple over 10 times sales. Even at 10 times sales, right? The head of Scott McNally, the head of Sun Microsystems in 2000 said it best. To make a 10% return, if you pay me 10 times sales for my company, I would have to give you all of my revenue for the next 10 years, which is a problem because I would go to jail. because I have to pay taxes, and I have to pay my suppliers, I have to pay my people. So you're not going to get a 10% return. Stock went down 98%. Company still exists, still a perfectly fine company. And I'm not saying Nvidia is going down 98%. I'm saying it's going to go down a lot at some point, but you don't know when. So the problem with trying to short these momentum stories is the 315 train problem. You're standing on the train track at 310 and you look up and the train's about to run you over. And you're like, no, you're not supposed to be here till 315. The problem is you're right, but you're dead. So step off the track, let the train come in, stop, then get on the train. So if you have interest rates at zero and people from around the world can go borrow money at zero and buy anything with a yield, that's a carry trade. So for years, the yen was the axe in that global carry trade, which was really interesting because other countries could have lowered their rates to zero, which eventually they did. And so there was this period 3 years ago where the yen actually strengthened. You're like, that can't be, right? Everything about this country is imploding except the quality of life. The quality of life is really, really high, especially if you happen to live already in Tokyo. Food's great, apartments are great, it's great quality of life. But short version of the long tail is once the Fed went back to punishing the masses by raising rates, or I should say unpunishing savers, right? Because by going to zero, you're punishing the savers and you're stealing money from the savers to give it to the rich because they lever up everything. So once they reversed that, the yen carry trade was back, and it has been back as the preferred trade. And so the dichotomy is, you're right. In theory, a country with 226% debt to GDP should implode. The yen should skyrocket out of control, and it should be a really, bad experience. But the demand for yen to fund this global carry trade, which is encouraged, by the way, is almost infinite because the fiat countries keep printing more money. So think about the race to the bottom. Everyone quotes DXY, right? Oh, look how strong the dollar is. No, it's not. It's just less weak than the yen or the euro. If you look at it relative to the renminbi, it's actually not strong. So this global race to the bottom is inevitable because of demographics. Demographics are destiny. 65 to 85-year-old people, they don't spend a lot. They tend to save, and they like fixed income. And so what we've seen as Japan first, then Europe, then the US, every single day, 10,000 people in the United States and Europe turn 65 for the next 7+ years. And that is going to continue to play out. So if you want to know what's going to happen in US and Europe, just look at Japan 11 years ago. And so, they peaked in 89, we peaked in 2000, their debt got downgraded. 11 years later, US debt gets downgraded. Same kind of things happen. And ultimately, I think the yen is a controlled demolition, not a out of control demolition. And I think the yen carry trade is back to being the most preferred because they're the place that still has zero rates.
Yusko also critiques the current approach of regulatory bodies, particularly in the US. He believes that the strategy of enforcing regulations through punitive actions rather than clear rule setting is flawed. He compares it to parenting without clear boundaries, leading to confusion and missteps. The lack of clear regulatory guidance, especially regarding whether certain cryptocurrencies are classified as securities, has created uncertainty in the market. This uncertainty has been exacerbated by recent actions from the SEC, which Yusko views as inconsistent and sometimes overreaching. He provides examples, such as the ongoing debates around cryptocurrencies like Cardano, Ethereum, and Solana. Yusko is critical of the regulatory environment that has allowed for fines and penalties on actions that were not clearly defined as violations at the time they occurred. He points out the irony of regulators targeting smaller projects while seemingly overlooking larger infractions by more established entities. This, he suggests, creates an uneven playing field and stifles innovation.
I think they do a good job, with limited resources. They try to do their best. However, I do believe that the current administration chose a tack that I probably would not have taken, enforcement by punishment as opposed to enforcement by rule setting. And so one of the challenges, it's like raising a child. If you don't have rules, the child flounders. They don't know what to do or what not to do. So you need rules, and they may push up against them. They may even cross the line, but at least they know there are consequences for their actions, and they know where the boundaries are. The problem with the current form of legislation was they kind of said, well, we're not going to rule per se on different cryptocurrencies or different utility tokens. We're not going to tell you whether we think they're a security or not a security. And sometimes even if we say they're one thing, we're going to change. That arguably is partly because one of the unknown little wrinkles, the SEC is not funded by the government. They're self-funding. They fund themselves through their fines. And so they have to have some regulatory actions on from time to time to pay the bills. So when people do bad stuff, they fine them. And if they do really bad stuff like spoofing the price of gold, they fine them a lot. The problem is those spoofers make so much more. If you pay $1 billion fine, but you made 20 billion, it's just the cost of doing business. So that's a long way of saying there are tokens that many feel near and dear to people's heart, like Cardano. I don't really understand it. I don't see any technical activity being built on Cardano. There's a lot of people that own it and trade it, but I don't really understand the use case. There are other things like Ethereum that I think have lots of use cases and lots of applications and lots of development activity. There are things like Solana that we own a lot of and actually sold a lot of and made probably more money than I've ever made in my career on that project. But today I kind of struggle that, yes, it's cheap and fast, but there's not very many people building stuff on it. And other than meme coins and NFTs, I really can't find many use cases for it. So, what's going to happen with XRP? Don't know. And ultimately, the SEC's stance lately has been shoot first, ask questions later. So they fine people for violations of rules that didn't even exist, which is kind of a weird paradigm. That happened at the Winklevoss twins, and it happened to DCG, and it happened to a whole bunch of people who were victimized by the real bad actor, FTX, which seemed to be very buddy-buddy with the SEC for some reason. So lots of things to unpack there, but ultimately, I think they put themselves in a place where they decreed certain things securities, certain things not securities.
Yusko's discussion also includes a reflection on the broader crypto market, where he acknowledges the speculative nature of many projects. He is cautious about certain tokens and projects, advising a focus on those with clear use cases and active development communities. For instance, while he acknowledges the potential of Ethereum due to its wide range of applications, he is more skeptical about projects like Cardano, which he feels lack significant technical activity. He also discusses the role of the SEC in the crypto market, noting that the agency's funding model, which relies on fines rather than government appropriations, may incentivize it to pursue enforcement actions more aggressively. This, Yusko argues, leads to a regulatory environment that is more about punishment than guidance, which could hinder the growth of the crypto industry. Please like and subscribe my channel.